Your wealth deserves stability, expertise, security. Your wealth deserves LGT Cresto, private wealth with over a century of global heritage.
Hello and welcome to the Global View on this Tuesday. Well, the US dollar has climbed to a more than 1 month high as investors have sought a safe haven because of worries over China's economy. Country Garden, China's largest private developer, is seeking to delay payment on a private onshore bond, triggering renewed concerns in the sector. China's real estate sector has suffered tumbling sales, tight liquidity, and a series of developer defaults over the past 2 years. And today, China releases further measures of its economy with July's industrial production and retail sales data. Well, the Aussie dollar, seen as a proxy for investor sentiment on China, has slid to its lowest level since May to trade at 64.7 US cents. And currency traders are also braced for possible Japanese government intervention after the yen hit its lowest level since November. 10-year US Treasury yields have hit a 9-month high ahead of retail sales data, which is expected to show solid growth in the US in July, in further evidence of resilience of the US economy. 10-year yields hitting 4.2% before easing to 4.18%, while the 2-year gained 7 basis points to 4.96%. Well, China's July industrial production, retail sales and fixed asset investment is expected to have decelerated from June, in line with the weak credit data we've seen, while markets have been spooked by China's property bond defaults. Let's get across it all. Zerlina Zeng joining us from Creditsights. Zerlina, good to catch up with you again. Well, let's start off with what we're seeing in the property sector at the moment, which has been big news, and we've seen how that's affected markets, particularly in Asia yesterday. Can you unpack what's going on there at the moment? As I mentioned there, certainly Country Garden, the largest developer there, that's seeking to delay payments on its bond. But we also have a major Chinese trust company that's missed its repayment obligations at the same time.
Yeah, sure. Thanks for having me here, Andrew. I think the Country Garden's default was not an entire surprise for the market because in the past few weeks, there has been a lot of negative news headlines regarding how the willingness to pay of the company had significantly decreased, including the chairlady transferring some of her shares in Country Garden Services into the charity foundation of the family. So this decrease in willingness of pay really already spooked the investors. Then when the onshore bonds were suspended trading yesterday, it was already not a surprise for the market. If you look at the dollar bond prices of Country Garden across the curve, it ranges from about a high single-digit cent to about 12 cents. So to some extent, the market has already priced in the default of this large Chinese developer. Then if we look at the physical property market, I think the overall situation hasn't been very encouraging. And one of the key reasons for a lot of Chinese developers' willingness to pay decreasing is because their contracted sales has been tumbling over the past 1 to 2 years. It feels like the future is pretty bad, and the owners to some extent thinks there's probably no point for them to staying on paying their dollar bonds and onshore bonds. If we look at the physical transaction data, volume has been very low. Price has been declining not only in lower tier cities, but also in selected first tier and second tier cities. The situation is going to be quite challenging over the next few months. Market so far has been expecting some big ban policy support coming from the central bank, but we haven't seen that yet. There has been piecemeal support measures here and there from the local government, but it feels like because of the challenging situation, those piecemeal measures are not enough. Back to what you mentioned about the trust company default, this came as quite a surprise for the market. The situation has been ongoing and the crisis brewing in the past few months, but still the scale of the default and the impact for some of the high net wealth individuals, it feels like quite bigger than market expectation. But our view is the contagion risk from this trust default is not very high for a few reasons. The first one is the impacted retail investors are ultra high net worth. The threshold for investing in this trust company product is about 3 million RMB. RMB. Secondly is because the trust industry has built up a lot of equity buffer in the past few years, and also about 85% of the Chinese trust companies are state-linked. So to some extent, we are going to see some government-related support or intervention if it evolves to a systematic crisis.
Well, Zerlina, beyond that, of course, I did mention that data we're getting out as well in terms of industrial production, retail sales, fixed asset investment, all expected to decelerate, or having decelerated from June. What is the expected response to that weakness we're seeing?
Yeah, so the data is going to be quite weak, and this is a wide market expectation. The downside risk is whether the new data prints will further surprise the market from the downside. I think on the stimulus measure front, market expectation has been very high, but I think investors need to be quite realistic about what the Chinese government could do or what they are willing to do. I think on the monetary front, in the second half of the year, we continue to expect a triple R cut and about 10 to 20 basis point of policy rate cut. I think the policymakers will be very much focusing on the transmission of the previously implemented monetary support measures, such as the increase in the borrowing from both business and home buyers. On the fiscal front, honestly, not really that much the government could do because of the elevated debt burden of local governments, as well as the transmission of the real economy at the moment, especially the low business and consumer sentiment. So I think the policy focus here will be targeted fiscal stimulus, namely towards the renewable energy, electric vehicle, or home appliance purchase in rural areas. Then when it comes to property easing measures, I think it's still wait to be seen whether the government will roll out a more broad-based property support measures, such as doing away with home purchase restrictions, lowering mortgage down payment on a nationwide basis.
Yeah, so that what in particular in terms of focus on the property sector, what you're expecting perhaps those borrowing costs for home buyers in particular could be lowered?
Yeah, right now the PBOC has been doing a lot of rate cuts, and these rate cuts are getting implemented for the new home mortgages. For the existing home mortgages, they are still using the old rate, which are about 4%, or some of them are about 4.25%. So there is room for further easing. If the PBOC could guide the banks to further lower the rates on the existing mortgage, I think to some extent that could boost the disposable household income. That could also marginally boost the home buyers' interest in buying new homes. But we do have a challenge here, which is the bank's interest margin has been calmed down in the past few years. The banks are also facing a lot of profit pressure, as well as accumulating potential non-performing loans from both the property and the local government vehicle sector. So I think the central government needs to balance the need to boost in home buyers' sentiment, as well as to make sure the banking system is still in a very good and healthy condition.
And Zerlina, what are you seeing in the corporate sector at the moment ahead of some of those results, particularly from large tech that we're likely to see? How do you view their creditworthiness at the moment?
So far on the earnings side, there actually has been some bright spot, which is really coming from the China tech sector. Last week, we had the earnings of Alibaba, which was a strong beat, both in terms of the revenue as well as profit, cash flow generation, and debt matrix. This week, we are going to have JD, Tencent, Lenovo. Next week, we are going to have more big tech such as Baidu and Weibo. Overall, we are expecting the sector to report quite resilient earnings for the last quarter because of their top line momentum is picking up. The online retail sales was doing quite good for the 618 shopping festival. And for the second half of year, we are expecting their credit matrix to stay very healthy and further pick up in terms of a revenue and cash flow generation.
Zerlina, so much happening in China at the moment. Terrific, you can get it right across it. Thanks so much for joining us from Creditsights.
Thank you.
All right, that is the global view. Just before we go, a check of the local markets. So global markets finishing a little mixed. We did see some positivity on Wall Street, mostly driven by some buying back into tech stocks, particularly the likes of some of those chip makers such as Nvidia. But given that we're looking for a fairly flat opening, as you can see, just 1 point higher there, given also that heavy selling we saw yesterday, so not a lot of comeback. Well, we are just a couple of minutes away from the open. Stay with us for that.